So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you give more all of it away to help MVPs, the most vulnerable people. My name is Brett Swarts. Each and every episode, we're joined by some of the world's top entrepreneurs, millionaires, and billionaires. They share their secrets, insights, and wisdom with us so we can all level up and scale up. I'm excited about our next guest. He's out of Virginia, and he is an expert when it comes to property management and also investing. It's kind of a neat combination to have both. And he's going to be sharing some secrets about that and wealth and building wealth in today's marketplace. He's got an extensive background. In 2007, after his search for a property management company that focused on specific needs proved fruitless, he began to dedicate himself to becoming one of the best property management companies and leading a team to do that. So since his inception, he's grown his team has grown to manage over 1,300 single family homes and over 2,500 multifamily units across the Commonwealth of Virginia, and so much more. Please welcome to the show with me, Mr. Kyle Stephenson. Kyle, how are we doing?
Oh, doing incredible, Brett. Thanks for having me.
Excellent. Let's dive right into the show. For our listeners, get to know you for the first time, would you give us just a little more about your story and your current focus?
Sure. So started off investing in real estate personally in the 90s. So was absolutely enamored about real estate and real estate investing. And so I would actually, while I was working as a retail sales guy selling toilet paper, Brett, during the day, I would read all different types of books about investing in the evenings. And I could actually read all night long, literally all night long, about real estate investing. Get up, not even get up, literally go to work. But I was so obsessed about owning that first piece of property. Bought my first piece of property in the early 90s. Actually at 142 Patterson Avenue, Patterson, New Jersey, a little duplex. I thought that was going to be just the launch of incredible wealth. And what it was a launch into an incredible education about real estate, because I did all of the wrong things and still made out okay. Continued to buy real estate, and over a 10-year period was able to buy some townhomes. I would save money. I would invest into another little piece of property. I would save money. I would invest into a little bit of rental real estate. And over those first 10 years, I would do everything on my own. That was painting, cleaning, you name it. In the early 2000s, I got some of my buddies to say, "Hey, Kyle, you seem to be doing okay. Why don't we get into the game with you?" And so I was very fortunate that there were some guys that were working for larger companies, real estate companies, that explained to me the basics of real estate syndication. And so I did a few syndications, and you'll always hear with family and friends. My family didn't have a lot of dough, but some of my friends had some money to put into some deals. And that's how I really started. But I was working also, again, 50, 60 hours a week in corporate America. In 2007, I thought the timing was right, Brett, to launch and do it full time, leave corporate America. Little did I know that there was going to be this massive recession. And so I also learned what it was like when banks could not or would not lend money, and how to really, again, um, actually help lenders out in managing their properties, because they were taking a bunch of properties back. And I was a sales guy, so I sold the bank on letting me help them manage their properties. And really, the rest is history. We then started to do a few more syndications. I started to buy more property. The world started to get better, and we're very fortunate now that we manage over 4,000 properties, over 1,000 clients. I've done a lot of syndications. I love what I do every single day of the month, except for maybe 2 or 3 where I think life sucks. But for the most part, I love and get up every morning enjoying what I think is the best investment in the whole wide world.
Awesome. Love it. We're serving Kyle Stephenson, everybody. You can learn more by going to krsholdings.com, krsholdings.com. So whether you're an owner, investor, or even looking for property management within the Virginia Beach area or other areas, he's going to share with us where he invests. So I love the story. I love the background. I love the determination. I love the love for real estate. I think one of the biggest challenges people face as they read this Rich Dad, Poor Dad book, and they get in their minds that they're going to have passive income, financial freedom, mailbox money, all of the really cool, neat stuff. But then they don't really get into the nitty gritty, Kyle, of the property management, or they get into these syndications and they don't really know how to do the syndication per se. They know how to tie a property up and market to get capital, but they close and oh my goodness, now I have to manage this operation, right? This business, this property. Kyle, what's the number one secret to building a successful property management execution of the operations, as well as an investor, facing company?
Brett, so I love the fact you just brought up Robert Kiyosaki, because I just was talking about Robert Kiyosaki yesterday, and probably speak about Robert Kiyosaki once a month, because I think that he has a lot of great ideas. Rich Dad, Poor Dad. I played the cash flow quadrant board game, 25 years ago. So love a lot of his ideas. I think the key to property management and to wealth creation is execution, right? We love to do deals, or a lot of people love to do deals, and they want to go do the next deal, and they want to go do the next deal, and they don't focus on executing after they've purchased something. And so you should have a plan. And it is funny you bring that up. I won't share too much, because if I even pull up this card, people would be able to kind of see everything that I have. So I don't want to share all that. But I take little index cards, and so on this index card, I'm just going to flip it around real quick. I actually will look at every investment that I have, what my goal is of that investment. And I've been doing this now for 30 plus years, what the goal is of that investment. I have a whiteboard that is sitting to my right, and it has everything that I want to accomplish. It could be on a monthly basis, whether it's, hey, at this property at 3012, I need to upgrade the lights, or I need to demo one of the apartments and I want to get it done by 11/1, and live by what are the goals and what we want to achieve, whether it's on a quarterly, monthly basis. Now, the property management side is very X's and O's, Brett, right? It's what are we going to do today to push the ball forward? So it's not deal making. So there are a lot of people that love the deal, but don't want to do the day-to-day ops. That's where property management comes in. But I would share, especially when you're getting started, you have to have an idea of what property managers do. So I think you got to do the first deal. You got to work it your first year on your own. Don't go out and get that property management company. I don't care about the schools that say, oh, ask your property manager this list of questions. You can't appreciate what a property manager does, this is my opinion, until you actually do it yourself. So you got to go through all 4 seasons. What is it like when that hot water heater breaks in the middle of the night? And by the way, it doesn't break for whatever reason. It doesn't break in the middle of just like any night. It's like Thanksgiving or flipping Christmas. Literally, past 3 years, we've had a hot water heater break on Christmas Eve. Why? I have no idea, but that's when they break, right? So until you can appreciate that, or the resident that says, hey, I don't know, I lost my job and can you work with me? And just things that happen, right? Or why on earth does it cost, $1,000 or $2,000 to paint something when the paint is only, $100? Like, you just can't appreciate it unless you experience it. And then at that point, you understand the value of a good property manager. So
okay, I got it.
That's a secret. I'm sorry.
Is so good. This is so
I
good.
get excited. I'm sorry, Brett.
That's a book. No, it's really great. I just want to make sure I captured it right. So it really sounds like you got to fall in love with the day-to-day ops. You have to fall in love with appreciating the 4 seasons of any kind of real estate in property you're managing. You got to appreciate the stress and the Murphy's Law that's going to hit. And you got to understand the numbers that is associated with each of these things to actually then unlock what value is for property management. Is that a fair summary so far?
That's very fair summary. You're good at this, Brett. Yes.
Okay, great. Let's keep moving here, right? Okay, so I think this year is the year of the jiu-jitsu tap out. Multifamily in particular had the three headwinds that were pushing it into exponential highest levels a couple of years ago. Very low interest rates, 100% bonus depreciation, double-digit rental rate growths year over year or close to it. Okay, for so many markets, and it created this just surge. And of course you still have Fannie Freddie, loaning on multifamily and this, housing and all that. It just boom, and it was just this huge surge of value or pricing, right, that went through the roof. And then you've got the last couple of years, it was like survive until 25. Well, guess what? 25 is here and almost gone. And now the arm bar is being held, right? Interest rates obviously doubled. Property taxes went up. Insurance went way up. And those who were caught not knowing how to properly manage through these different seasons of not just the real estate, specific micro level, but the macro level are the, like Warren Buffett says, you see who's been skinny dipping and now they're getting, caught. And now their arm's about to break and they're just, they're giving back to the bank. They're trying to do these capital calls. I mean, it's kind of a bloodbath, and that's like people aren't really seeing. It's kind of the underground bloodbath. I'm curious, are you seeing those same things? And do you agree with that statement that 2025, and maybe I guess it's going to be 2026 too, is the year of the jiu-jitsu multifamily tap out?
Yeah. So if you don't have staying power, all right, you're going to have a problem. I think it's real important. One of the things that when some of these syndicators had modeled the valuation of their assets, right? They're like, oh, we're going to be able to grow rents by 10% because we've been growing rents by 10% for a few years, right? So the unfortunate part for some of these guys, number one, you can't grow rents by 10% right now, right? And you may even need to take a look at concessions to relet assets. You have new assets that are still finishing construction from the boom, right? Because it's just that's what's going on. And if you take a look, Brett, here's what's killer. You start taking a look at some of these markets like DC. If you pull up right now on apartments.com in DC, they're offering 3 free months of rent just to get people in to lease up projects. Well, how do you think that affects all of our assets, right? It's going to drive us to do the same thing. There's a trickle down. So unless you have some staying power, right, you're going to have a problem. And so if you're not that astute investor with a little bit of money, maybe saved, you could have a big problem right now. I that's my belief. I see it. I'm seeing it.
100%. And so this is where I want to go into it. I'm so grateful that you survived and went through the 2008 crash, right? And when you got into the business, by the way, I jumped to the real estate at Marcus and Millichap in 2006, right? And in fact, I graduated college in '07, but I was being trained in '06 and '07. And then just as I got some momentum, the market took obviously a big hit, and real estate market took a hit, although it took about 3 years for the real estate market to bottom out. But here I think is one of the biggest mistakes, Kyle, okay? People, they focus on cash flow, which is obviously, a tenet of success, right? And building wealth, okay? But they don't focus on tax flow as much as they should. And they don't focus on debt flow, or they take it for granted, right? But worst of all, they don't combine all three, okay? And so when they exit, they use in a 1031 exchange, and not that it can't be a great solution, but oftentimes they're selling high and buying higher in the same market, and it's putting them in a compromised position, okay? And or they're using bonus depreciation as a reason to buy the deal and underwrite it, right? Because I've got this tax write-off. And the fundamentals of the business are not sustained by the cash flow just on itself, right? Or at least the durable cash flow moving forward. And then they go, oh shoot, that didn't work out. Now the whole thing's a mess. And so our premise, and I'm curious what you think, is really getting time back on your side to be able to do all three of these. And so I think staying power is having flexibility within the cash flow, tax flow, and debt flow world. And it's not using a 1031 exchange. In fact, we as real estate pros, if you will, we know when the markets are high and prices are through the roof. I think most of us would have said that, yeah, 2018, 19, 20, I remember 2021, we're there, or it's going to change. I can't go for this long. Oh my gosh, went for another year. Oh my gosh, went for another year, right? There was that sense. I remember this. And so I'm curious, did you sense that? And then second, what's your biggest challenge with the 1031 exchange if and when you're using them?
Wow. Great questions. I want to make this statement. So again, on my little cards that I look at, that I try to keep in front of me, I look at principal curtailment. So when I look at an investment, I look at principal curtailment, I look at cash flow, and I look at appreciation, and I understand what asset, okay, what for that asset or that portfolio, what's going on at any given time. So I think about those levers. So it is so interesting that you bring this up. A lot of that goes back to also, yes, real estate, you can do cost segs and you can have bonus depreciation, which is back under the big beautiful bill, right? All of that's great, but you gotta do, I don't know if I'm answering your question, but when buying a deal, you still have to make sure it's going to be that right basis, okay? What we're gonna buy it at. The financing is ridiculously critical because we always need to consider, above everything else, I don't want to hear about the appreciation. I want to make sure that I have the right, they call it your debt coverage, okay? And so these are things, Brett, for me, are ridiculously important. Now, that 1031, and yes, I've done 1031s. I don't, when I buy a 1031, that other deal still has to be at the right basis. This is where people get into trouble. And if you're looking to fund a real estate deal, you're nuts. That's not the way you got to make sure that the financing, that everything works well. And I have a client right now that unloaded, I closed last week, and he had the 2% interest rate. And when the rate started to go up, I was like, hey man, you gotta lock that rate in. He's like, oh, rates are gonna go back down. Well, he got upside down. And so where he was making a bunch of dough, okay, and crushing it, he got greedy, thought that rates were gonna go back down. He ended up losing 60% of his invested capital. And this is on a several $1 million deal. because he got greedy. So even on that 1031, on these other deals, on bonus depreciation, all that should be gravy, Brett. And I know it's hard to find deals right now. I get it. But you shouldn't chase the basis. So hopefully
Couldn't agree with you more. And I want to provide some solutions for people and maybe even give you an idea or two, Kyle, of this, right? Reasons I'm asking these questions. And here's what I heard you say, right? By the way, you mentioned, cash flow appreciation, and you said principal. I don't know the second word.
Principal curtailment. So
what does that mean?
So just how much we don't take into consideration sometimes how much on your financing, whether it's interest only, right? That means you're not curtailing or reducing any of your principal, okay? Or of your loan, okay? Yeah. Or am I, can I do a 30-year amortization? Can I do a 25?
So how much you're paying down, how quickly, right? So yeah, you're going in the right direction to get out of debt.
Correct.
100%, right? So debt flow is what we would call that. Cash flow, what you said, and then you said appreciation, and yes, and I would say tax flow as a part of that. So, which is bonus depreciation, 1031s, all things. Okay, all right. So here's the big secret, Kyle, that you may or may not know about, and I want to just kind of bring this whole thing to life here. And by the way, here are some key stats: 100 trillion transferring over the next 5 to 15 years by the baby boomers. 10,000 baby boomers turning 65 every single day. 80 million baby boomers in the U.S. alone. Okay. About 50% of the total net worth is commercial real estate, high-end primary homes, and businesses, private equity. 2/3 of which are not qualified for 1031 exchanges. And then the other one, commercial real estate, the challenge is even if they want a 1031, like you said, the interest rates went from 2 or 3% to 6, 7, 8%. And it's a negative arbitrage situation. And so they're selling, and even if they had sold at the peak, the problem is they're having to overpay at the peak, right? And so you've got to get time back on your side. And so we have developed a process and a system that allows for using IRC 453 installment sale reporting with the trust to eliminate the need for the 1031 exchange forever. And I think it's the biggest kept secret. And I'm going to give you some key client deal stories to bring this to life. Okay. $13 million exit for a client out of San Diego. This was about 3.5 years ago. And the interest rates were still really low. We knew the market was hot, right? Guess what? They developed properties and they bought an old taco stand and then they combined it with the land next door and they put the taco stand inside of their car wash. That's like a 2-acre parcel in San Diego. And so they're all in for $4 million, Kyle. They manage and they operate the business amazing for about a year and a half. And the value goes to $13.5 million. Okay. Now they have debt and obviously a pretty low basis and massive capital gains tax in California, but they are smart in that they said, we don't want a 1031 into the hottest market ever, right? That they felt. And also, we don't want to be rushed under the gun and we have this debt. And so they were either just going to pay the tax or they found our service. And so they found me on YouTube. Our company's called Capital Gains Tax Solutions. We built a custom plan for each of the partners to defer their tax without having to finance the buyer. Because the traditional installment sale is not great either, because guess what? You finance the buyer, your collateral is not diversified. It's not liquid. It's tied to the old asset. And as entrepreneurs, we want to go to the next deal. So our model eliminates the old installment sale method, although we use the structure as the foundation for the tax code. And we build this trust, and this trust issues a promissory note in exchange for what they would receive at closing. And this is how it works. And so at the close of escrow, the buyer, comes with $13 million. He gets debt. However, he got the debt. He probably got a 3-year, adjustable arm. They should probably call him back right now and see what's going on. And we get the cash into Schwab. Okay. And better than that, they get a promissory note, defer 100% of the capital gains taxes. And the biggest thing is their leverage is now they have time on their side. Okay. So they sold high and then we started to diversify into what? Real estate debt that was paying double-digit returns. Because our strategy doesn't require like-kind replacement. They even went into some Bitcoin at 40,000 a coin. And we know it's like about 115,000 a coin. They went into some stocks, which I'm not a huge stock guy, but they got some good buys. They went a lot of it into money market account, just waiting. They went into some hotel stuff that was like distressed, and they got into some nice hotel opportunities. The point is they diversified mostly into real estate using our strategy. Now here's a full circle moment. It's been a couple of years now, and they've just been waiting for the real estate market to go back down. Our strategy allows them to partner with this trust to go back and buy that real estate at a discount. Okay. To me, this is the biggest kept secret that people don't know about. It unlocks the fourth quadrant of Robert Kiyosaki's fourth quadrant, right? Because it actually provides truly passive income. Like you can now get out and not have to be an active owner. You can go into syndications tax deferred. It doesn't require any kind of carve out or 1031 model. It can go into real estate debt funds or real estate private equity funds or whatever. It really is open source. Okay. And so this is what we focus on. If people want to learn more, you go to capitalgainstaxsolutions.com. But I'm wondering, Kyle, you've been in the business for a while. Have you ever heard of anything like this before?
No, I'm so you have me taking notes right now. So I'm unaware of it, and I thought I was a fairly astute investor. So you actually have me pretty excited about this, Brett.
What about it makes you excited? Because I want to hear it from you.
So I think it's so one of the challenges that you have from a 1031 tax exchange also is that you are, you're trying to get a deal done on the 1031, right? You got to close on that deal, and then you have 45 days to identify another deal. And when you're in a ridiculously hot market, it's really hard. And so I will give you a real world example right now. An asset that we have been trying to market. I'm more of a real estate collector, so I'm not really good at selling. But in this case, we were selling an asset. It's in a partnership. And then we were 1031ing into a deal that we knew from an investor from out of the country that just needed liquidity. But we knew the asset that we were buying, and we know the asset that we're selling, and we're still, so because I've identified it, I still have 180 days to close, but it's been brutal. And we tried, again, on some other things that we were trying to sell to line up other deals, and we ended up paying the capital gains. Why? Because I'm a basis buyer, right? So what I like about what you're doing is it doesn't feel like to me I have a timing issue, and so that I can be opportunistic in getting in at what I just said, the right basis in deals.
Precisely. And let me break this down for everyone, right? This is so cool. And so what I'm going to say to everyone is, if I could show you how to forever eliminate the shotgun wedding, the 1031 shotgun wedding, get engaged in 45 days, get married in 180, right? Probably or maybe overpaid, or at least didn't make the deal you could have made, because the seller, guess what, knows that you're in an exchange, is not going to offer probably any kind of real concession, right? And is going to probably pick you as the offer because they know, guess what, you're likely to close. All the things, meaning the leverage is with the seller. We offer, by the way, what's called the best 1031 exit plan. And I think it's malpractice for any real estate professional or anyone who's in real estate to ever use a 1031 exchange company that doesn't give you an alternative to a 1031 exchange. By the way, I want to be real clear too. What we offer is not the Delaware Statutory Trust. Most people get this confused. Those are just another form of a 1031 exchange where you give them all control, all liquidity, all diversification. Our strategy is completely outside the 1031 world. And I'll give you a real life example. We just did a sale for a property in Monterey, California, a $5.4 million apartment sale. This gentleman has been managing properties for 20 plus years. This is his third exit with us, okay? And so on the other ones, we actually did partial 1031s, or at least he went for his 1031. So we give a solution where you can go shopping and just go look for your 1031. And if it doesn't work out, you can use our strategy. If it does work out, you don't owe us anything, right? You just, great, way to go. We applaud you. You're one of the few that found the needle in the haystack in this market, right? We also had times when we do partial 1031 and then partial our strategy. So it's a combo. And in fact, sometimes it requires that because there's things what's called like debt over basis challenges that we have to solve for, that we help with the Delaware. We do that with. We had a client in Texas had a $6 million exit. He did a partial 1031, a partial Delaware, and then our strategy. Now, the reason people mostly want our strategy, and the reason my client just used it for the $5.4 million sale in Monterey without a 1031, is they want that timepiece. They don't want the pressure to have to do anything, and they want the opportunity to do something when those deals do come up. And here's the reality. It took 3 years from the 2008, basically the crash for the bottom of the real estate market, 2011. We're seeing the same thing. If you would have said, the low might have been, this year or last year, right? Or we're not quite sure where it's at, but if you start to gauge when the high was, it's going to be about 3 to 4 years until it kind of gets to the low and works its way back up. And that is that window of opportunity to sell the real estate at a high, get out of debt. But here's the key: cash flow, debt flow, right? Get out of debt flow, tax flow, defer the cap gains tax, and then still have cash flow. Again, we usually like real estate debt. We're getting like 10% on a real estate debt at 55% LTV opportunities and funds that you can get the money in about 30 to 60 days. So we have the whole model all mapped out. But then as a real estate entrepreneur, you can partner with the trust to go back and buy those deals. Okay. And so we have clients that have developed multifamily properties after they sold a business. We've had clients start businesses after they sold Bitcoin, all by using our strategy. So that's kind of it. So yeah, the answer is yes. If people want to learn more, go to capitalgainstaxsolutions.com. We wrote a book on it called Building the Capital Gains Tax Exit Plan. But it's hard to find folks, Kyle, like you, who've been through all of it and know the pain of deals that you wish you could sell, but you don't want to pay the tax. Want to get out of the property management for some of the deals, but you're like, I don't want to, chase a 1031. I'll just hold on to it. Know that you could have sold it at a whole huge price, but now it's down by 30%. So because of the tax, right? People just settle, and I don't want anyone to settle.
Wow. This is, I hoped that I was sharing some valuable information to your listeners. And
I feel like, I'm kind of the guy to be interviewed now. And I know I don't want to make it about me, but I just think this is so key from someone like yourself who's listening. So let's keep going here, right? And let's try to connect some dots, right? So for someone like yourself, Kyle, you're doing syndications. Talk about a couple live deals you have going on, right? How are you bringing in capital? Right. And then let's kind of just discuss if someone's an investor, like, hey, I like that Kyle has property management expertise. He's got obviously lots of time in the marketplace, lots of experience. Walk them through maybe some opportunities that you might have or that you're seeing. So in case people want to jump in with you.
So first of all, I am a very unique syndicator because what I do is so let's talk about syndication, I guess, first. Mm-hmm. So syndication looks like you're partnering with a general partner and a limited partner. That limited mm-hmm. partner may have exposure, may not have exposure when buying a piece of property. Okay, and then mm-hmm. that limited partner may or may not have. They'll have either more or less benefits than the general partner. And so we'll just kind of, that's what that looks like. And so the mm-hmm. syndicator goes out and they raise money. All right. So let me tell you what we've done. First of all, I focus only on residential. Okay. So that's all I do. And it's either multifamily or it could be portfolios of homes. That's what I'm good at. I think I'm really, really good at that. I am an operator. I am a day-to-day grunt. So most of the things that we buy we really look for just mismanaged assets, things that I know that if you just manage them properly, there's an upside. So I don't invest, generally speaking, in anything super sexy because I don't have incredible vision. I just like working every single day, making sure people pay their rent, and then making sure the debt is where it's supposed to be. Kind of knowing where the repairs are going to be, all of that. So it's not, so with that, the good news is there's usually a coupon right out of the box. And what we call a coupon, it's what we pay our investors on a quarterly basis, every quarter, kind of quarter in, quarter out. That's the goal. I am always the largest investor in every one of our deals. So for example, we purchased a roughly 200 unit apartment community in Chesterfield approximately 5 years ago. Our goal is always to get everybody's initial investment back within a 5-year period. On that deal, we raised, call it $5 million. Of that $5 million, I was the largest investor. I also will take on the debt. So I am responsible for the debt. That is something that is different than a lot of syndications where you have to sign that you have some recourse. I take 100% of the recourse. I'm the largest investor. And then there will be a coupon of some sort. So on that deal, the coupon started at 6%. We were fortunate enough that that coupon grew to 8. And then this was a really, really good deal. So I don't want to, the people have gotten multiple amounts of their money back. But we bought it at a really good time. It was very well very poorly managed. And so, and then usually over a threshold, and that threshold is either going to be 6% or 8%. The general partner, which is me, will get a certain amount of love and a bonus. So a lot of times it's an 80-20 structure for me. So every dollar above, let's say that's 6%, the limited partners would get 80%. I would get 20%.
Yeah.
So that's really the model.
I love it.
Yeah,
I love the model. I love the model. You're signing on the debt. You're putting your largest investor. You're doing the day to day. And that's honestly that is the best model if you're looking for commercial real estate syndicators to partner with, because the other model, not that they're not 80-20 or the pref or whatever, but the other model is they're not first day-to-day grinding operators, right? Like what Kyle is talking about. And the sexy appeal of the marketing or the sexy appeal of the podcast, the YouTube channel or the thing, it's like, but who is the day-to-day operator? Who has the thousands of units? Who's got the decades of experience on the day-to-day operations? Because that is the most important thing. If you don't have that, you can have the best business plan, but you don't have the team and the systems and the processes and the experience and the wisdom to execute, the rest of it really doesn't matter, right? And you can buy it at perfect timing, and maybe you try to get out before the market shifts and you catch a wave and now you got a return. So you got to be looking for operators that have been in multiple real estate cycles, especially when they got their start mainly in 2007 and worked their way through. This is Kyle Stephenson, everybody. You can learn more about him by going to KRSholdings.com. He's the real deal. I know from 10,000 hours being in the real estate business and interviewing and seeing and absorbing. I've only met Kyle for 7 minutes here, but I know he's the real deal. So go to KRSholdings.com to learn more. Kyle, are you ready for the lightning round?
Absolutely. Maybe.
All right. I love it. Know what you know now. If you can go back to your 20-year-old self with the one gold nugget, make sure to tell yourself to do.
Be patient.
That's good. I love it. Question number 2. What are you most curious about right now?
So how I can leverage AI to strengthen my relationships and increase my productivity. I mean, that's what I'm most curious about.
So good. Question number 3. What's the number one book you've recommended or gifted most in the past year?
Ooh. Oh man. So I love, but it's Scaling Up by Vern Harnish. And if you're running a business, or I love that book. That book I can read over and over again. Love it.
Okay, excellent. Love it. Question number 3. Number one leadership quote or theme that you strive to live by.
Only because you're asking me this, I have so many quotes in my head.
It can be a theme. It can be a theme too. It doesn't have to be like an exact quote.
I mean, I will say again, I'm on the leverage kick. So, for me and for my team, it's always making a positive difference in individuals' lives. But I have so many other
I like it. Make a positive difference in individual lives. That works. It's great. And figuring out ways to leverage and do that. Question number 4. How do you stay ultra disciplined? How do you best stay ultra disciplined?
Journal every day, write lists, check off lists, live off of a Google Calendar, take a look at my goals for the years, look at that, read them aloud once a week. So I'm pretty disciplined with that stuff.
I love it.
Time management classes. Yeah.
Good. That's fantastic. Number one way you're using like a chat GPT or an AI system recently that just kind of, you're like, man, this is the one we're going all in on. It could be chat GPT or something else.
Wow. So I use chat GPT, and it could be, a lot of times it's me talking to chat GPT about my thought process on certain things going on in the business or on an acquisition, and then for chat GPT to research the web and then poke holes into my thoughts. I know that sounds weird. I don't want to go down a road that I'm not, that for some reason I'm just missing. Where are my blind? Where are your
blind spots? I love it. Poke holes, search the web. Where are my blind spots? Yeah. Fantastic. And very last question, Kyle, we'll wrap it up. After all your success helping all the people you help, how do you best stay centered with a mindset of stewardship over ownership?
I would say, again, the individuals that I touch, I allow them to potentially buy into certain deals. We're constantly out educating individuals. So there's some charities that I promote, the Fatherhood Foundation, which I'm really big on having a father in one's life. We support a lot of nonprofits that help on financial literacy. So another nonprofit we work with is Urban Hope. And so it's really helping those individuals that probably need financial literacy the most, providing grants so individuals can learn about that. So that's kind of my gig. So but again, it's really focused around education and financial literacy to help and raise others up.
Kyle Stephenson, it's been more than a pleasure. I want to just thank you for being on the show. I want to thank you for sharing your wisdom with us, deep insight on property management and investing, geeking out with me about the 1031 exchange and all our strategy, which we offer at Capital Gains Tax Solutions, which is an installment sale with the trust. All of these things. This has been amazing. I want to encourage you to keep using your gifts and talents to help more people create and preserve more wealth, make a bigger impact with their wealth and with property management and housing, one of the top crises in the world that you are on the front lines of providing. So keep doing what you're doing. It's a good work. For those who want to get in touch with you, one last time, Kyle, would you remind them, where can they find you?
K Stephenson at KRS Holdings or KRSholdings.com. And, hopefully this conversation here made a positive impact in the listeners' lives.
I'm sure it did. Thank you so much, Kyle. And also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels as well. We're on this journey with you to scale from millions to billions so we can give more all of the way to help MVPs, the most vulnerable people. I want to encourage you to take action today. Rewind this and listen to it again. Share it with somebody. Take action. What's one thing you can do that can get the leverage and the momentum in your favor for anything that Kyle and I talked about? And of course, if you have a massive exit in Bitcoin, business, or real estate, and you have huge capital gains taxes, we want you to go to capitalgainstaxsolutions.com. You can schedule a one-on-one consultation with myself, one of my team members as well. Pick up the book, Building a Capital Gains Tax Exit Plan. It is an amazing book. We have Kevin Harrington from Shark Tank in the book, and you can check that out by going to Amazon or capitalgainstaxsolutions.com. Hey, get started today. We appreciate you all listening and watching, and we'll talk to you again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.